How would you like to invest in high quality dividend paying stocks in financial sectors that are considered to be undervalued and have a track record of over 10 years of dividend payments? Well, my name is Mo, and in this video on Momentum Finance, we're going to be covering this topic and introduce to you 4 high quality stocks that meet these criteria. Let's get into it. All right. Our very first pick is a company called Prosperity Bank Shares. It's available with ticker symbol PB in the financial sector. Currently has a dividend yield of 2.94%. Uh, Prosperity Bank Shares has a dividend safety score of 92, making it a very safe dividend payer. And it was last traded at the price of $70.66. It has a market cap of $6.45 billion, making it a mid-cap size business. Prosperity Bankshares last increased its dividend back in October of 2021, where they increased it by 6.1%. From a volatility perspective, if you look at the beta, which is a measure of volatility compared to overall stock market's volatility, we are looking at a low volatility range with a score of 0.65. The score of 1 suggests that a company has similar levels of volatility to that of the overall stock market. If we look at some additional metrics for the Prosperity's Bank Shares dividends, you notice that they currently have a payout ratio of 37% and a forward payout ratio of 35%, both of which are low for banks, suggesting that they have a ton of room to continue to increase their dividends and continue to pay it for years to come because they have a low dividend payout ratio. It's worthwhile mentioning that during the recession years of back in 2007 to 2009, their revenue increased by 3.1%. And in terms of their stock return, although the stock was down by 39% during those years, from the difference between their highest price to lowest price between 2007 and 2009, that definitely was better than overall decline of stock market for S&P 500 by 55%. Prosperity Bank Shares has a dividend payment history of 26 years. They have paid it uninterrupted for those many years. And of the last 22 years of those, they have increased their dividend year after year. That's quite a reputable and kind of nice track record of dividend payment and dividend increase. It's worthwhile mentioning that over the last 20 years, they have increased their dividend payments very fast by an annualized 12%. Over the past 5 years, they also maintained a fast dividend increase of 10% per year. And as indicated earlier, then the last time they increased it, it was by 6.1%. We're going to take a look at their dividend in kind of frequency. We are looking at a quarterly dividend payment by Prosperity Bank Shares. It's paid in the months of January, April, July, and October. For investors in Prosperity Bank Shares, currently they can expect an annual payout in total of those 4 quarters, which comes to a total of $2.08 per share in dividend income. As for the timeliness of the stock, you're currently looking at the stock suggesting to be undervalued for a couple of reasons. First thing that we are noticing is that their dividend yield is about 13% above their own 5-year average. What's more, their forward price to earnings ratio that is shown to be at 11.7% is well below that of their own 5-year average, which was sitting at 13.7. Although it's slightly higher than that of the financial sector, it's always nice and important to compare their forward price to earnings ratio to their own historical data as well. It gives you a good gauge of how historically investors have treated this business, how they have valued it, and how they're valuing it currently. Their last trading price is hovering slightly closer to their 52-week low price, which was at $65.09. It's worthwhile mentioning that in the past 1 year, the highest that the stock has hit in terms of its price was at $79.55. We're going to take a look at a number of additional financial measures here. The first one being their earnings per share. Ideally, we would like to see the business continuously increasing its adjusted earnings. For the most part, if you zoom out, we are seeing that upwards trend. There are years that they have had a decline in their earnings per share compared to previous years, but from there on, they've managed to find their way back through that upwards trend for sure. As you noticed, in the last 12 months, they reported 5.50, or they are showing actually $5.50 in earnings per share. And for the next 12 months, they're estimated to have $6.03 earnings per share, which if it comes true, is the highest that we've seen in the past 10 years. Next, we're going to see how they've managed to increase their sales over the years. Overall, as you notice from this chart, in terms of the sales growth, there have been a few years that they have their revenue or total sales declined, but they have been 6 years in the past 10 years that they have increased it by extensive amount. In fact, in 5 of those years, they have increased by double digit. 1 year, it was increase of 1%. And let's take a look at there. In 2021, they reported $1.13 billion. And in 2020, they had one of the highest years in the past 10 years. In fact, it was the highest at $1.14 billion. In the last 12 months, they are also showing $1.12 billion in total sales. Number of outstanding shares, ideal scenario would be for a business that has its shares buyback and rather than actually issuing more shares. Here, we are seeing that the Prosperity Bank shares are actually issuing new shares. So maybe a little bit of not the ideal situation because they have almost doubled their amount of outstanding shares since the past 10 years ago. But that's one factor we take a look at. It's not everything. The other thing we want to point out and bring to your attention is their return on equity. Ideally, we would like to see for banks being above 9%. There have been a couple of years that they have surpassed that threshold, but for the rest of the years, most recently, although they haven't met it, but their return on equity is kind of lagging just slightly behind at 9%, showing more around the 7 to 8% mark. We're going to take a look at the data from Seeking Alpha. We are using the Seeking Alpha Premium Access. For those of you who might be interested in such a feature, we'll add a link in the description of the video whereby you could get a discounted access to Seeking Alpha Premium, which gives you access to a wide wealth of data around different businesses. On top of that, one of the features we'd like really there is around the Quant ratings, which is kind of a tool algorithm used by Seeking Alpha to assess whether a company or stock is based on their assessment considered to be a buy or a hold or a sell, and all of those details. We'll dive into it in a moment. But first things first, let's take a look at the past performance of this stock. In the past 1 year, the stock was up by 7.3%. The past 5 years, it's up by close to 16.9%. And in the past 10 years, they're up by a cumulative 64.3%. As pointed out, based on the Quant rating, we are seeing here that the stock is a buy with a score of 4.21. You notice how this is mainly driven by their latest revisions and as well as the price momentum for the stock. You notice how this assessment of the stock has changed over the time at different price ranges and at different dates as well. Again, as pointed out, these data is based on the premium access to Seeking Alpha, and you can check out such access based on the link provided for a kind of promotional access for you at a discounted rate to access Seeking Alpha's premium. We acknowledge that we have access to the Seeking Alpha premium through a partnership that we have with Seeking Alpha to access these data points for this entertainment video. Next, we're going to take a look at our second pick, which is First of Long Island Corporation. It's available with ticker symbol FLIC. It's a small cap business. That could explain why maybe many of you might not have heard necessarily about this business. It has a market cap of $412 million. But we are going to point out why it is considered to be a good possible option for dividend investors. We're going to walk you through it. And at the end of the day, of course, it's based on your own research and your decision. We're not necessarily saying that the investors should just blindly go ahead and buy any of the stocks that we talked about on this channel. We're just pointing out the method that we analyze these stocks and different data points that we take into account for us to consider whether a stock is a good choice for investing, whether it's for dividend investors, growth investors, or for others for that matter. First and foremost, this stock has a price range of under $20, so it might be easier to kind of put aside some funds to buy this stock in that sense. Like their barrier to entry probably is minimal in that sense. With the last trading price of $18.02. It has also higher dividend yield with a dividend yield of 4.44. And their last increased their dividend back in September of last year by 5.3%. It has a safe dividend score and a very low volatility of 0.41, suggesting stock you can anticipate a ton of volatility for the stock price. It has a forward payout ratio of 78%, which is considered to be low, although their current one is at 41%, edging slightly higher for the banks. They have a dividend payment and dividend in growth streak of 28 years, which is just impressive. If you want to rely on some of that past data points to take some of those, make some of those decisions. Currently, the annual payout for this share is 80 cents. Again, it may not be as high as some of the others, but keep in mind the dividend yield is higher because the stock price is definitely lower here. It does also pay its dividends quarterly in the months of January, March, July, and October. And if you look at the timeliness, it does appear to still be undervalued. First and foremost, its 5-year average for dividend is typically at 3.43. And here we are seeing that this dividend yield of 4.44 is about 30% above their 5-year average. On top of that, their forward price to earnings ratio of 8.7 is well below their own 5-year average of 12.4 and also below that of the financial sector. And lastly, their last trading price is hovering very much closer to their 52-week low price. If you look at their earnings per share, you're seeing for the most part that nice upward trend. If you look at their total sales, again, you're seeing that nice upward trend. They have increased their existing shares, definitely issued some additional shares since the past 10 years. But if you look back around 2018, at that point, they had 25.5 million outstanding shares. And since then, they are kind of declining and buying back their own shares. They're currently at 23.4. And lastly, if you look at their return on equity, they well meet that threshold of 9% for the banks. If you look now at their last trading price for the stocks and their performance in the past 1 year, the stock price is down by 8.6. In the past 5%, the stock is down heavy by about 36.6. But in the past 10 years, longer term horizon, if you look at it in the past, their stock is cumulative up by 30.8%. It's interesting that despite the 5-year decline, the stock has still showing a positive return over the past 10 years. This is of interest because the stock market investing is in many cases is a longer term game. You cannot necessarily expect to get into the market and make a killing. Sometimes, of course, you have to be patient. You might be lucky at times and really have a perfect run, but for the most part, as investors, you have to be patient and do your research and buy actually stocks that you believe in them, no matter their short-term ups and downs. Based on the quant rating, this is considered to be a strong buy with a score of 4.57%, with a valuation score of B and a revision score of A. You can also see how the past history in the different days, the stock is continuously remained as a strong buy, at least since early August. That's what we're seeing from them. And that's where the stock was still hovering around that $18.94. As we pointed out, the stock is now hovering closer to that $18 point. Let us move on and look at the third pick, which is Aflac. It's a life and health insurance financial sector business with a very safe dividend score and a dividend yield of 2.69%. Aflac was last traded at a price of $59.50 and is considered to be a large cap business with $37.6 billion. They last increased their dividend back in November of 2021 by 21%, a very fast dividend growth. It has a low volatility for the stock with a score of 0.69 for its beta. From a payout ratio for dividend, they have a 25% current payout and a forward payout ratio of 31, both of which are considered low for insurance business. If you look at their dividend history, 39 years, just a remarkable kind of track record of paying dividends and increasing their dividend year after year for the past 39 years. You also notice how they have been increasing their dividend fast or very fast over the past 20 years that you're showing here based on the records. For Aflac, they have an annual overall payout of $1.60. That amount is paid by quarter, and you receive these quarterly dividends in the months of March, June, September, and December. The stock is considered to be undervalued as well. First and foremost, their current dividend yield is about 13% above their own 5-year average, and their forward payout ratio is in line with their own 5-year average of 11.4. The stock price is hovering slightly in between, but maybe hovering a tad bit closer to their 52-week high price. And the highest that their stock had hit was $66.62. In terms of their earnings per share, for the most part, you're seeing that upward trend for the last 12 months and the next 12 months, you are seeing that some of that decline though, with the next 12 months estimating to have $5.24 in earnings per share. If that comes true, it would be less than 2021, but higher than any of the past 9 years over the past 10 years that you're looking here on this graph. As for their total sales, you are noticing that expected 7% decline in the last 12 months. their total sales is showing some signs of kind of slowing down. That may not be necessarily the greatest sign, but we will take that into account with other factors. For instance, the fact that they have been able to sustain for the most part their earnings and increase their earnings per share. That's an important aspect as well. On top of that, they have a long history of their dividend payment and dividend increase. Again, that's another reassuring factor. And the fact that they have a low payout ratio, so they are able to continue to pay and increase their dividends, and they have a safe dividend score. They have been buying back their shares aggressively too. You notice the last 12 months, they have 658 million outstanding shares. That's definitely a nice sign. And in terms of their return on equity, they're showing double digits in all of the past 10 years, which surpasses the preference of 10% for insurers. If you look at now the stock return in the past 1 year, the stock is up by 9%. The past 5 years, they're up by 42%. And in the past 10 years, look at that, a massive, nice 147% approximate cumulative return in the past 10 years. Just incredible. And if you look at their quant rating, they're showing a strong buy with a score of 4.81. You're noticing here how this scoring of the quant has changed. Again, since mid-August, they're showing a strong buy. And if you look at early August, that's when things have switched from a hold rating. And at the time, the price was hovering around $58, and currently also is around $59.50. Lastly, we are going to take a look at our fourth financial sector business. It's a company called Reinsurance with ticker symbol RGA. Reinsurance Group of America has a dividend yield of 2.48 and a dividend safety score of 99, making it a very safe business. It has a mid-cap size from a market capitalization with a market cap of 8.65 billion. It was last traded at the price of $129.07 and has a low stock volatility with a beta of 0.83%. Reinsurance Group of America has currently a high kind of payout ratio of 64, but if you look at their forward payout ratio, they're in much better spot with only a 23% forward payout ratio. They have been paying their dividend for the past 27 years uninterrupted, and in the past 12 years, they have increased it year after year. You'd notice how they have increased their dividend very fast over the past 5 and 20 years. And if you look at their overall amount of dividend amounts, which is paid by quarter in the months of March, May, August, and November, the total annual payout comes to $3.20. From a timeliness perspective, their dividend yield of 2.48 is about 15% above their 5-year average. On top of that, their forward price to earnings ratio of 9.2 is kind of well below their own 5-year average of 11, all of which point out to the stock potentially being undervalued. Though I'll want to raise to your attention that the stock has kind of recovered from some of its lows and is now hovering closer to its 52-week high price, which was at $131.65. We are going to be taking a look at their earnings per share and see how things are panning out there. You notice in 2021, they had a absolutely poor performance. Their earnings per share kind of declined massively, but they are doing better in the next 12 months, estimating to have $14 in earnings per share, which would be the highest in the past 10 years. On top of that, if you look at their sales, they are showing a total sales of 16.2 in the last 12 months. It's one of the highest in the past 10 years. In 2021, they showed 16.77 billion. All in all, you're showing that nice upwards trend. On top of that, they are gradually buying back their shares, although in 2021, in the last 12 months, they are issuing them some new shares, but still it's well below that of their past 10 years in 2012. So in the last 12 months, they are indicating $67.8 million in outstanding shares. Return on equity is the one part that you're noticing they are kind of lacking a tad bit. The insurance preference is actually at 10% return on equity, but since 2018, you're seeing how they are falling below that. In fact, in the past 10 years, there were only 3 years or 4 years that they meet that threshold. It was 2012, 2014, 2016, and 2017. And other years, they have not met that. But that's one of the factors. It's not the only thing for us necessarily to take into. While they might not meet necessarily all of the while they might not actually be able to check the box on all of these factors, it's still worthwhile we look at it more holistically and not just necessarily fall in love with the stock for one metric or hate stock for another. I think you have to take all of them into account side by side and see how maybe performing poorer on one would impact the rest, and whether that's actually a meaningful impact. If you look at the past performance for RGA, in the past 1 year, they were up by 14% by stock price. Past 5 years, they were down by 5.4. In the past 10 years, they were up by massive 120% plus. Just incredible. And based on quant trading, they are showing a strong buy with a score of 4.89 out of 5. Although the valuation may not be the greatest based on the quant trading, getting it a score of D in terms of the growth, profitability, momentum, and revisions, they're showing very positive signs. If you look at historically as well, around by early August, they were showing strong buy, but prior to that, like you see, even going as far back as May, end of May, they were still starting to show signs of a buy rating. At the time, the price of the stock was $125. Now you're hovering closer to that $129.07. Something for you to keep in mind. What this suggests to me is that maybe from a valuation, according to at least this quant rating, the stock may not be the greatest. But let's say if you're a long-term investor and are considering to be wanting to take advantage of, let's say, potential for its profitability, for its growth over the long span of time, then this might be a good option, even at these valuations. At the end of the day, we want you to make sure to do your own research and don't necessarily blindly buy any stock that you hear or see on YouTube from even on our channel or any other analysts anywhere on the stock market or any of the analysis websites. This is your money, so you want to make sure that you are confident and comfortable with what choice you are making in terms of investing in a stock market. Well, thank you so much, everyone, for watching this video until the end. I hope you found it beneficial and gained something of value from it. If you did, don't forget to smash that like button and subscribe to our channel. Here on Moementum Finance, we post every week several videos about investing, including investing in growth stock, dividend stocks, penny stocks. We also talk about investing in crypto and ways to reach financial freedom. Thank you, and I hope to see you next time.